While there is no gainsaying that technology will play an even more decisive role in the post-COVID-19 new normal, the better run players will definitely gain out of vendor consolidation, related market share gains, and also greater digital offerings to clients. The earnings report from HCL Technologies also offers similar optimism while sounding cautious on the near term as well. In our Ideas for Profit today, I will discuss whether this IT major can be a good addition to your portfolio in uncertain times like now. While albeit some impact of COVID-19 in Q4 FY20, the broad momentum was sustained with the company reporting a revenue of $2.5 billion, flat sequentially and a growth of 0.8% in constant currency terms. Now for FY20, the revenue was $9.9 billion, sequential growth of 16.7%, of which 10.7% was organic growth, better than most of its peers. Now, the company had moved 96% of its employees to work from home quite seamlessly in Q4, and 2.5% was still working on site. Now, in the quarter, growth was largely driven by digital business, Mode 2 in company's parlance, that grew by 5.6% sequentially. Now, HCL software that really houses the products and platforms encompassing all the acquired businesses, including the latest acquisition, that is of the IBM products, reported a very healthy margin growth, and the commentary on this business really suggested it is unaffected by COVID disruptions, as these products remain critical for businesses even now. Now, in terms of industries, the usual suspects, namely technology and services, healthcare and public services, did well in the quarter, while telecom, media, publishing and entertainment, manufacturing and also financial services lagged behind. Now, the diversified industry exposure of the company should stand it in good stead in troubled times like now. Another highlight of the quarter was the 63 basis point sequential improvement in margin to 20.9% this time. Now, management of HCL Technologies also mentioned that Q4 saw the highest deal bookings, with the company bagging 14 transformational deals, including one that was signed post the lockdown. Now, on a like-to-like basis, the order book is up 12% compared to the last year. The company also continues to see decent net addition to employees, which also shows the confidence of the management on achieving growth and also a stable attrition rate. Now, it did not allude to retrenchment or change in benefit for employees, except for change in the variable compensation for now. Now, in the light of the uncertain environment, the company has also skipped the guidance for FY21. But that does not mean that all is lost because of COVID-19. There could be some immediate pressure points emanating from the demand side, and hence the management also expects a deterioration in its performance in Q1 and a return of stability in Q2 and growth in the second half of the calendar year. Now, overall, the company is also expecting lesser impact on business to consumer, that is B2C firms, and more impact on B2B, that is business to business firms. In addition, there could be a volume decline also. The company also might have to give temporary pricing discount for a couple of quarters, as well as extension in the payment terms to help clients really tide over the current crisis. Now, it is sitting on a healthy cash position of $1.2 billion, and that really provides comfort. Now, COVID-19 also provides a plethora of opportunities for the company. It expects greater demand for its solutions in the areas of, say, fluid digital workplace from its non-infrastructure management clients as well. Now, apart from this, the digital transformation would gain pace with the goal of achieving zero-touch interaction with clients from here on. It is also looking to gain out of vendor consolidation as smaller players lose out market share in this space. Now, the overall management commentary was definitely optimistic, albeit the near-term challenges that it did point out to, which are well understood. Now, the stock, with a correction of 16% in the past 3 months, has really outperformed the Nifty as well as the IT index. We would really advise investors to add HCL Technologies on every market correction, as the long-term proposition really remains strong, and the company is also likely to be a winner in the post-COVID-19 era of new normal.